This is Al Brooks, and this is my price action trading course. The current module is about protective stops. What's the purpose of a protective stop? It's to protect you against yourself, not to protect you against the market. Emotions can influence your decision making, and without a stop working at all times, you'll sometimes let losses grow and grow and grow and grow. And it will take many, many successful winning trades to make back the losses that you allowed to occur. If you have a protective stop, you can protect yourself from making that mistake. No matter what size stop you choose, you have to make sure that the total dollars at risk are within your comfort zone. Are you going to risk $100? Are you going to risk $1,000? Whatever your comfort zone is, never risk more dollars than what you're comfortable losing. If you're worried about losing money, you will lose money because your emotion will interfere with your trading decisions. And if you're using a very big stop, make sure to trade a much smaller position because you don't want to trade a much bigger stop than usual with your normal position size because you'll be risking far more dollars than you normally risk, and that will make you nervous and you will not manage the trade objectively. You'll lose money. So let's say your stop has to be 3 times bigger than what you normally like to use. Then your reward, remember your reward is always at least as big as your risk. So your reward has to be at least 3 to 6 times bigger than usual. Okay, which is good. You're making a lot more profit. However, because your risk is 3 times normal, if you don't want to risk any more dollars than you normally risk, you have to trade small, like 1/3 your normal trade size. Okay, you can, if it's a trend, you can swing part of your trade or all of your trade. There are always trade-offs among the 3 variables in the trader's equation: risk, reward, and probability. A swing means you're going for a big move and a big reward, but there's a trade-off. Big reward usually means low probability, and the probability is often as low as 40%. In some of the best setups, like major trend reversals, the probability is usually between 40 and 50%. But if you're swinging, you're going to get a reward twice as big as your risk, or more than twice as big, and that still results in a very favorable trader's equation. In all trading, you have to make sure that the profit target is at least as big as the protective stop, right? You always want a reward at least as big as your stop. In a bull trend, you have higher highs and higher lows, and it's contained within a rising channel. The bottom of the channel is the bull trend line. Since a bull trend is made of higher highs and lows, as long as the market continues to make higher highs and lows, it's still in a trend. If it stops making higher highs and lows, it's not in a trend. So if you're holding a swing based on the premise that the trend is continuing, and it's no longer continuing if it falls below the most recent higher low, in other words, it's making a lower low, most swing traders usually trail their stops below the most recent higher low. So every time the market makes a new high, they raise their trailing protective stop to below the most recent higher low, because if the market stops making higher lows, in other words, if it falls below the most recent higher low, their premise is no longer valid. The market's no longer in a trend. It might be in a trading range, and the trend might be over. A bear trend, it's a series of lower highs and lows, and it's contained within a falling channel. The top of the channel is the bear trend line. Since a bear trend is made of lower highs and lows, swing traders usually put their protective stops above the most recent lower high, because if the market goes above that high, their premise that it's a bear trend may no longer be valid. So they're betting on a bear trend continuing, making lower lows and lower highs. If it goes above a prior high, it's making a higher high instead of a lower high, and it may no longer be a bear trend, and a lot of the swing traders will get out once the market stops making lower highs. Whenever you're in a position and you have a protective stop working, the protective stop is there to protect you from a loss that could grow very large. However, you only stay in the position as long as your original premise is valid. If you're looking at the market and the market's going against you and you believe that what you believed when you put the trade on is no longer true, don't wait for your stop to be hit. If, for example, let's say you bought thinking the market was always in long, and then the market did something to make you believe it was now always in short, even if it has not yet hit your stop on your long trade, you get out immediately. It does not make any sense for you to continue to rely on a stop based on a premise that is no longer true. So the stop protects you, but you also should actively protect yourself. If the direction of the market changes or something happens so that you believe your trade is no longer sensible, don't wait for your stop to hit. Just get out at the market and take the loss. Some people use very wide stops when they trade. For example, a measured move away from a trading range. And their intention is for the stop never to get hit. They're trying to give themselves room. They're not sure, for example, if they're buying, they're not sure if they bought the exact low, but they think that the market is in the process of reversing, and they're willing to allow it to go lower. However, they'll sometimes have a stop that is very far away. They'll trade small enough so that if the stop gets hit, their losses are not too big. However, if the market does go below their entry price and does something to make them think that their premise is wrong, that the market is not bottoming, and in fact it's trending down, maybe it's in a bear channel instead of in a bull pullback, maybe the pullback has grown so far that it's probably now a bear channel and a bear trend. Even if the market is far from their protective stop, their original idea is wrong, they get out immediately. That wide protective stop is just to protect them in case of catastrophe. For example, in case their data went down, in case their internet went down, in case their broker software went down, in case who knows what, in case they get a phone call, in case something happened, right? That protective stop is to protect them from a disaster. However, they should not rely on only one means of protection. And another obvious means is once you believe your idea is no longer true, don't just hold on to the position and hope that the idea once again becomes true, right? You have a responsibility to do the right thing, and if your premise is wrong, you should not be holding a trade based upon a premise that's no longer valid. Just get out immediately and take the loss. Here's an example of scaling into a bear trend. The market gapped up but then sold off and had 3 strong bear bars here. So it became always in short for most traders, certainly by this bar. For most traders, probably by this bar. There was a trading range, a breakout, and support down here at yesterday's close. Most traders would assume we're going down to test yesterday's close. And that maybe we'll get a trending trading range day, an upper trading range, a breakout, and maybe a lower trading range. Okay, to me, I think this is not a high probability short. If you take it, you may be taking a trade that has a 40 to 50% chance of success. You're taking it as a swing. Your stop is above the most recent lower high for a swing trade. So initially your stop is up here. And since it's not a highly probable trade, you're hoping to get a reward equal to twice your risk. So your risk is from the stop to your entry price, 1 tick below the signal bar. You entered right here. And then a measured move down to twice that distance, which is well below the bottom of the screen. You could convert the trade into a smaller profit based upon actual risk after entering. I talk about that in another module on actual risk. But for right now, let's assume you're going for a reward twice your risk because it's not a high probability trade, and let's say you take that short. you certainly were not happy by this close, right? You don't want it closing above the bottom of your signal bar with a big tail. Possible parabolic wedge. There's a slope across the bottom here and a steeper slope here, so it's parabolic, and it's 3 pushes down, so it's a wedge. It's possible that this is becoming the low of the day. But let's say, for argument's sake, you took the short and you're willing to sell higher, maybe on a 50% pullback with a stop up here. So if you normally trade 100 shares of the spider, maybe you shorted 100 here, planning on putting another 100 here on and exiting everything up here. But you'll also exit if your premise is no longer valid. At this point, with these 3 bull bars closing, 2 of them closing near their high, 2-bar reversal, strong breakout bar, 2-bar reversal with this bar or that bar or both. We did not quite get down to yesterday's close. We have tails on the bottoms of these 4 bars, and we have some buying pressure up here, decent bull bars and tails. The day at this point is probably back to always in long. So if you shorted here and your premise was that the market's in a bear trend and that you were going to scale in higher, maybe 50% pullback somewhere up in here, by the close of this bar, you'd have to conclude the market is always in long. So your original premise is wrong. You know, you thought that you were in a bear trend, and now the market is always in long. So what do? Do you scale in and hope to get out, break even on the entire position, maybe exiting somewhere in the middle of your 2 prices? No, that's not what you do. You've now concluded that the market is always in long, and you're short. You can't do that. You have to get out immediately at the market. As soon as you decide that your premise is wrong and that it's now a bull trend and always in long and going higher, you have to get out at the market and take your loss. And it's as simple as that. This leg down, 3 consecutive bear bars is good. However, it's still within yesterday's range. Yesterday's range had a lot of reversals. We have many reversals going on here, and prominent tails and decent bull bodies. Certainly 3 good bull bodies here. So this is probably a bear leg within a trading range. It's possible that this is the low of the day, but a bear signal bar, that to me is not reliable. So I suspect that the day will be a trading range day. And this is how it ended up. This low one short became a 1-bar final flag. We had a parabolic sell climax, 1-bar final flag, and a reversal up, always in long. There was some follow-through buying, and there was even a second leg up. But ultimately, we went down to a new low in the day, and then reversed up again. That's what trading ranges do. They run above resistance. Remember, the swing stop for the bears was above this high, and the market went above it, only to turn back down. New low of the day, and then turn back up. And that's what trading ranges do. They run stops, they run below swing lows and reverse up, they go above swing highs and reverse down. For protective stops, you have 3 choices. You have a price action stop, like beyond the signal bar. So let's say you're buying a reversal up and you have a very strong bull reversal bar, that's your signal bar. A price action trader might place a protective stop 1 tick below its low. Sometimes traders use a money stop, like a certain number of ticks from their entry price. So let's say a trader is buying a strong bull spike at the market. You know, they may put a protective stop 10 ticks below. Also, traders often use measured moves for their protective stops. So if they're buying in a pullback, for example, and they're not sure that the pullback has ended, they may make a calculation of a measured move, maybe based on the height of the pullback, and put their protective stop there. So again, a price action stop based upon the bars on the chart. The price action, if you're buying a bull reversal, you put the stop 1 tick below the bottom of the signal bar. If you're selling at the top, and you have a bear reversal bar, a bear signal bar, and you short below the signal bar, your protective stop is 1 tick above the signal bar. Let's say you have a very big signal bar. A lot of traders won't want to risk that many ticks to beyond the signal bar, but they might be willing to risk to beyond the middle of the signal bar. They can also, so they can put a stop, they can find out where the middle of the signal bar is and place a stop a tick or two beyond that. They may also use a money stop, like 10 ticks from their entry price or 50 ticks from their entry price. That's also a valid approach. Here's an example. Look at the size of this bar compared to the other bars on the chart. It's 2 to 3, 4 times bigger. Very big signal bar. So if a trader shorted the close or shorted below the signal bar, let's say they shorted 1 tick below the low and they got filled over here, a lot of traders might not want to risk to above the top of the bar. It'll be too many ticks. And maybe they don't want to trade that small. Instead, they might trade their normal size position and put a protective stop just above the midpoint of the bar, for example, right here. That is a reasonable thing to do. And then as the market trades down, they can tighten their stop. Here's another way to handle this. So instead of putting a stop above the midpoint, and instead of using a price action stop above the top of the signal bar, they may simply say, well, I always risk 8 ticks in the E-mini, 2 points in the E-mini, so I'll just go ahead and I'll use a 2-point stop. And in this particular case, that worked. Let's say you have an expanding triangle bottom, which is a type of major trend reversal. Your minimum objective, your profit target, is above the top of the triangle. The reward is usually much bigger than the risk. So we have a bull signal bar at the bottom of the expanding triangle. A price action stop is 1 tick below the bull signal bar. You buy 1 tick above the signal bar, so you get filled over here. Your stop is here. You could do that, and that is a reasonable approach, using a price action stop, a stop below the signal bar. You could also use a money stop on that same trade, a reasonable number of ticks from your entry price. For example, your money stop might be the size of your average bar. For day traders, that might be about 10 to 20% of an average daily range. So for example, let's say you bought above this signal bar and you're deciding on how far away your stop might be. You might want to put it a reasonable number of ticks below your entry price. And let's say you're trading the E-mini, you might decide, I usually risk 10 ticks, 2.5 points. I'll just place my stop at 2.5 points. And I'll allow the market to trade below the signal bar, but I will not allow it to fall 10 ticks below my entry price. So a lot of traders think, well, I'm good at picking approximately the bottom, but I'm not very good at picking the actual bottom. So for example, if I bought here, look, it fell a tick or two below my the low of the bear and it turned up. It might do the same here. So rather than exiting with a loss at 1 tick below my signal bar, I'll use a wider stop, maybe 10 ticks down, and I'll try to hold for a measured move up. So if I'm risking 10 ticks from my entry price, I'll try to take profits at least at 10 ticks above my entry price. You could also use a measured move target to help determine where to put your protective stop. You can base it on several things. You can base it on the height of the signal bar. You can base it on some kind of a gap within the pattern. Or you can base it on how far away your profit target is. So again, this is that same expanding triangle bottom. You could use a protective stop based on the height of the signal bar, saying, okay, I'm buying here. I'll put a stop equal to the height of the signal bar, which would be down here. A reasonable thing to do. If the market is going to reverse and you did not pick the actual bottom, it probably will not fall much further. You can see over here it fell below, but not much further before it found buyers here and here. Here it fell below, but not too much further before it found buyers. Over here it fell just a little bit below. And if had you bought any of those areas here and put a stop this number of ticks below the swing low, your stop would not have been hit, and you would have been able to make at least a scalp up. So using a measured move target based on the height of the signal bar, that's a reasonable approach. Most traders do not use that approach. They use other approaches. And you can also use a measured move based on the height of a movement from a gap. So for example, here we had we have a measuring gap here. The close of the bar is below the low of the prior bar. The pullback after the breakout bar came to below the low of this bar. This gap is the distance between the breakout bar, this low, and this high. So this, once the market started to turn down, you can look at this and say, that could be a measuring gap. And it turns out that the market reversed up right around a measured move down. Traders might say, okay, I'm not really good at picking the exact bottom. Let me go for a wide stop based on the height of that measuring gap. So my stop would be down here. And if that is the case, you'd go for a measured move up the same number of ticks. So if you entered here and you put a stop down here, you'd need to go for a measured move at least equal to that same number of ticks. So your minimum target would be somewhere up here. Most traders would not take this approach, but it is a mathematically sound approach. Here's an example using an extreme stop, an extremely large stop. The market is in an expanding triangle. A decent looking signal bar, so the context is good, expanding triangle. All expanding triangles, bottoms are lower low, major trend reversals. We have a trend line, I did not draw it. A reasonably strong break of the trend line and the moving average. Gap bars, lows above the moving average, usually leads to the final leg before a significant reversal. And then we have a lower low reversing up. So it's a lower low, major trend reversal, and an expanding triangle with a good signal bar. So the context is good and the signal bar is good. This is a reasonably high probability trade, maybe 60%. 60% means the probability of the next 2 points up is greater than the probability of the market falling 2 points. The next 3 points up greater than falling 3 points. The target is the top of the expanding triangle, and that's about 5 points up. So the probability is maybe 60% chance that the market will go up here 5 points before it falls down here 5 points. So this is a reasonable catastrophic stop. Like all stops, if the premise changes, you get out and you don't wait for the stop to be hit. No one using a stop this wide is simply going to take the trade, get long, and then walk away and wait to see if their profit-taking limit order got filled before their stop got hit. Although mathematically that is reasonable and it results in a positive trader's equation. If a person saw something happen after they entered that made them believe that the bottom is not in and that it's now a bear trend resumption, and let's say they decide that somewhere down here, right? Let's say we get a strong bear breakout, something like this, okay? 2 or 3 strong bear bars below this low. At that point they're going to say, well, the bottom failed and the market is now back to always in short, and it probably will have a leg down equal to some measured move target, and the obvious one would be the height of the triangle, so this would be the target. So if they conclude somewhere in here that the market now is always in short and that the bottom failed and that the market is probably going to reach a measured move target down here, they're not going to continue to keep their protective stop here and wait for it to get hit. As soon as they believe that their premise has changed, that this is not a bottom and that the bear is resuming, they're going to get out. So people who use these very wide stops rarely ever let these wide stops get hit. They exit long before then. They use the wide stop just in case the market does something very quickly and then reverses and goes their way, and they don't have enough time to make the decision. Wait a minute, did the market just flip to always in short? What's going on here? The wide stop gives them time to think. They can leave the stop in until they can clearly make a decision. Yes, the market has become always in short. Oh, okay, I'm going to get out at the market down here or down here and not wait for my stop to be hit. Or they'll decide, oh, that's just a stop run, going down 2 or 3 points below this low, and it's now a climactic sell climax, and it will be followed by a strong rally. You know, the very wide stop gives them time to think, but once they do think that their premise is no longer correct, they're going to get out. So whenever someone uses a very wide stop like this, it's just to prevent a catastrophe from happening. If their data goes down, if their broker goes down, if the internet goes down, and they're long, they want to make sure that there's some limit to what they can lose, so they use this very wide stop. However, if at any point they decide that the trade is no longer good, they're going to get out immediately. They're not going to rely on the stop. So most of the time, when you use an extremely wide stop, you have no intention of ever letting the stop get hit. You'd get out long before, but it does give you time to think. And once you've had that time, and once you've come to your conclusion, whether or not a break below this area is simply a sell climax that will lead to a reversal, or whether it's a resumption of the bear trend and therefore there's no bottom and the trend will keep going, then you decide what to do. If you think the bear is going to continue and that there is no bottom, you get out. And once the market starts to turn up, then you convert the stop to an actual risk stop. So for example, at this point, and certainly by this point, traders would be thinking the market's always in long. So at that point, they would put their stop below the signal bar, the bottom of the bull spike. And then their actual risk is from their entry price, one tick above the signal bar, to the now new protective stop, the trailing stop, below the signal bar. And they may take part off at 2 times that risk, which would be somewhere around here. And that's probably why the market went sideways here. Probably a lot of traders took partial profits at 2 times the actual risk. Okay, a wide protective stop. A lot of traders feel like they're not very good at picking exact tops or bottoms, but they're willing to risk more than beyond the signal bar because if their premise is still valid, they'll allow the market to go against them a little bit and bet that the market will go their direction very soon. I just gave several examples of how to use wider protective stops, and the trader's equation always has trade-offs. If you're using a wider stop, you're obviously risking more money, but you usually receive higher probability of success in return. So the wider the stop, the more likely you'll make a profit. However, when you do lose, you'll lose more ticks than you would with a tighter stop. If you're using a wide stop, you have to trade smaller size to keep your total dollars at risk the same. So you have to adjust the size of your position. As your profit grows, if your swing stop is very wide, make sure to take profits to scale out of your trade to reduce your position size. You hear me many times in this course talk about trading small, especially when the stop has to go far away. However, for option traders, they can use stock replacement strategies as an alternative to trading small. For example, let's say the market is in a strong bull trend and the stop has to go 3 times further away than you normally want your stop to be. What an options trader will do, or what a stock trader who also trades options will do, is he'll sell out of his stock and he'll replace his stock with an option strategy. The most obvious and easy ones are he might buy a call or a call spread. If the market's in the breakout phase of a bear trend and there are no pullbacks and the stop has to go far, far above where you are right now, an alternative to trading very small and putting the stop far away is to sell out of your stock and buy back your short and replace it with a simple option strategy. For example, buying a put or buying a put spread. And therefore you immediately greatly contained your risk. For example, if you buy a put, the most you can lose is the price of your put. And that might be 1 or 2% of the current price of the underlying stock. So your risk has become greatly smaller by replacing your stock position with a position in the options market. A lot of traders don't trade options, but that is a very popular strategy for traders who trade both stocks and options. There are other more advanced strategies like collaring up, but I'm not going to go through them in this course. I might do that in a subsequent course. Your initial protective stop, that is the size of your initial risk, and therefore it determines your initial minimum target. You want to target at least as big as your initial risk. You can start with any logical protective stop, and that is your initial risk. And again, you need to go for a target at least as big as your risk. Okay, so let's say you bought above the high of this bar, and you decided to use a very wide stop based on a measured move down on the height of this last bare leg. So your stop is down here, all right? And let's say you bought above the high of that bar. You would not have been stopped out here. You're using a very wide stop, so you have to trade very small. And your target would be at least as big as your risk, so somewhere up in here. That's based on your initial risk. Most traders ultimately do not base profit targets on initial risk. I'll talk about that in a minute. Traders adjust their initial stop after the market goes their way. And this is optional, but it makes sense, and it reduces risk. It also reduces probability, but it reduces risk. So for example here, if you bought one tick above the high of this bull signal bar, and you had an initial stop way down here, that is your initial risk, and this is your initial target. Okay? When you look at the chart at the end of the day, you see that the market never reached your initial target, right? However, that's not the point that I'm making here. That is your initial risk, and that's not your actual risk, and that's not your actual target. That's your initial target. Had the market gone down further but did not hit your stop, you would, and then it reversed up and started to go towards your target, you would have been happy that you had such a wide stop. All right, so after you're in the trade, let's say the market goes against you a little bit, and then it starts to go your way. You can count the number of ticks that you would have had to have used for your stop to avoid being stopped out. That is your actual risk. And you can go for a target based upon your actual risk, which is always at least as small as your initial risk, and usually smaller. When 2 times the initial risk is too big, you have to give thought to other ways to take profits. This is common in trading ranges, where there are often pullbacks after the entry, and the signal bars are sometimes large, and it's simply unrealistic to go for a target that's 2 times the initial risk. What you can do is instead go for a target that's 2 times the actual risk, and if the setup looks like it has a high probability of success, you can exit at 1 time the size of the actual risk. So for example, if you're trading the spider and your actual risk is 10 ticks, you could go for a 10-tick scalp. I would never go for smaller than a 1-point scalp in the E-mini or a 10-tick scalp in the spider, because otherwise commissions and slippage become too large. So let's go back to that same chart. Okay, so you bought above the high of this bull signal bar. Your initial risk was down here, so you did not get stopped out on the new low here. But then the market started to go your way, and by the end of this bar, you can say, if I had a stop 1 tick below the low of this bar, I would not have been stopped out. So I actually did not have to risk all the way down to my initial risk. My actual risk was from my entry price to 1 tick below the low of this pullback, which fell below my signal bar, but did not hit my initial protective stop. So this is my actual risk, one tick below this pullback bar. So when this bar closes up here, you look back and you can calculate what your actual risk was, and then you can change your profit target to equal to your actual risk. So this is the measured move based on the actual risk. Actual risk, entry price, measured move up, that's your profit target. And you can see that a lot of traders did that. You can see the tails on the tops of these two bars. So a lot of selling took place. A lot of it was bulls selling out of longs. Okay? This is how most traders trade. Okay? Nobody talks about it, but this is the reality. Most traders trade based on actual risk. A lot of traders don't think about it. You know, they're much more subjective. But in actual fact, mathematically, you'll see that the market often makes pullbacks exactly in the area of actual risk. And that tells you that a lot of the computers are using actual risk for profit taking and for taking trades in the opposite direction. Okay? You know, this is an extremely important concept, and it should be incorporated in all of your trading. Going back to that same situation, okay? If a trader bought above this signal bar and they had an initial stop here, and then they immediately get a second really good looking signal bar, it's a second signal, higher probability, a lot of traders will buy more one tick above this bar. At that point, they may put their stop below the second bar, because at that point they're taking a second entry long and it's a very good looking buy. They don't want to hold the position if the market falls below that second signal bar. So most traders would then put their protective stop below this second signal bar. Whenever you're taking a second entry long, you don't want the market to come down a third time. It came down once, it came down twice. You bought once, you bought twice. Most traders will get out below that second signal bar. And that's the correct thing to do. Let's say you have a second signal after you enter. A lot of traders will buy more. Okay, for stops and strong breakouts, a trade-off among the three variables in a trader's equation. Now the probability is very high. If you have high probability in a strong breakout, there has to be a trade-off, right? Something, you can't have high probability, high reward, and low risk, right? In general, whenever you have a high probability trade, you need a pretty wide stop. That's the trade-off. You have to, okay, let's give a specific example. Okay, here's a very strong bull breakout, a very strong bull trend. Once you're up in here or in here, everyone knows the market's always in long, and it's probably going to have a second leg up before it falls below the bottom of the spike. So traders will look for every reason to buy in here. They'll buy above the high of the prior bar. They'll buy below the low of the prior bar. They'll buy bear closes, right? They'll buy bull closes. They'll buy a breakout above a prior swing high, right? They'll be buying for any reason, confident that the market will go and have at least a second leg up, okay? Let's say you bought anywhere in here and you're looking for that swing up. You have several choices for your stop. This strong breakout bar closing on its high above the high of the day and way above this high is where the traders started to think that the market became always in long. So traders might place a protective stop one tick below the high of this breakout bar. That would be the tightest stop that a trader might use. Other traders may say, well, the trend really began with this very strong bull bar, so the market should not fall below its low, so they'll place a stop below the breakout bar. Other traders who bought, let's say they bought one tick above this signal bar, they may put their stop one tick below the signal bar. Once they saw this strong entry bar, they may place their stop one tick below the entry bar. All of these approaches are good. They're all sensible, good approaches. The wider the stop that you use, the higher the probability that you'll make a profit. But you're also having a greater risk, so the few times that you do lose, you'll lose many more ticks than you would have lost with those tighter stops. When you are using the wider stops, you have to adjust your position size to keep the total number of dollars at risk. you can see we had this strong pullback here. It did not close the gap above this breakout point. So we had a gap in here, and it probably resulted in a measured move up, although I did not calculate it on this chart. So from the low of the move to the middle of the gap, which is right around this green line, a lot of traders would look to take profits at a measured move up. Protective stops serve a purpose. They protect you from yourself, and don't pretend that they'll never get hit. They do get hit, and that's what they're there for. If the move is going against you and you did not exit early enough, your stop will get hit and you'll take a loss, but that's okay. Remember, if your stop is 2 times further away than you normally would like to have it, you trade half size. If it's 4 times further away, you trade quarter size, because you always want to trade small enough to keep your risk within your comfort zone. You never want your risk bigger than what you're comfortable losing. And if you buy late in a trend, for example a bull trend, or sell late in a bear trend, you rely on your stop even though it's far away, as long as your premise remains valid. If your premise changes and you decide, hey, this trade is not good, then get out at the market. If you're not sure, rely on your stop, and don't worry if your stop gets hit, because even if the stop is 3 times as many ticks as you normally like to use or for a stop, you're trading 1/3 size, so your loss is no bigger than with any other position. Here's an example. The market gapped down big, went probably always in long above this first bar of the day. Certainly during this bull spike it went always in long, and since it's always in long, you can buy at any point and rely on your stop. Since you believe it's a reasonably strong bull trend, your stop would go below the most recent higher low down here. So even if you bought way up here at this close, you put your stop down here, and you say, well, wait a minute, I only want to risk 20 ticks or 25 ticks in the spider, and this is 3 times bigger than what I want to risk. Well, then you trade 1/3 your size. And as long as your premise remains valid, that the market is always in long, rely on your stop and don't worry about it. If your stop gets hit, you don't lose any more than you do on any other trade. During the sell-off, we had a bear breakout, but followed by a bull bar. We had another bear breakout, but followed by a doji bar. So this is not behaving well for the bears. So yes, we're trending down, but it's not flipping to always in short. So for me, it still is always in long. And if I bought here, I would hold long and rely on my stop, even through all of this. Down here, we probably are forming a double bottom, bull flag, so you could buy above here, you could even buy above here. And a higher low major trend reversal. The market was in a bear trend. We broke it strongly, we broke out of the trend strongly, above the trend line, and we formed a higher low major trend reversal. So to me, if I had bought this tick, this way up here at the top, and I had my stop down here, I probably would double my position here, or certainly add a piece more on here. And if I bought here, I probably would raise the stop for my entire position to below the double bottom. And as long as the market remains always in long, it's okay to hold long and rely on your stop. Here's a similar situation. A gap up, strong bull spike, follow through, market's always in long. Good follow through here, and another bull bar here, so follow through after this breakout. So let's say you bought way up here, right at the very top of the market, and you decided, okay, I think it's always in long, I'm going to bet that we get follow through. And then you look and say, well, wait a minute, my stop is $1 away. That's 5 times or 4 times. Let's say it's 4 times bigger than I normally will risk on a trade. Well, if you do buy here, then you trade 1/4 size. So if your stop gets hit, you lose no more than you do on any other trade. If you held through all of this, you would have been stopped out, and the loss that you had would be 4 times as many ticks, but since your position size is 1/4 your normal size, the loss would be no bigger than with any other trade. Now, I hold long even if I buy the high tick until my premise changes. And in this particular case, we have a very strong bull trend, trend line break for about 10 bars, and then a lower high with a bear signal bar. Arguably this is a reasonable lower high major trend reversal. And had I bought here, I probably would have exited here. I might have reversed to short, I don't know, but I probably would have exited here because I would have questioned my premise. Strong bear breakout with bear follow through, If I had not exited earlier, I would have exited here. I would not have waited for my stop to be hit down here. Because once I believe the market is always in short, then clearly my premise is wrong. And why wait for my stop to be hit if I now believe it's always in short? If I believe it's always in short, I believe it's going lower. So usually when you have a stop that's far away, it does not get hit because you exit before it gets hit. Something will happen that makes you question your premise. Hello? High 2 and low 2 setups, a high 2 bull flag, a low 2 bear flag. Why do they work? It's because of counter-trend traders. Let's say you have a bull trend and then bears short and the market goes up, forming a high 1. And let's say they short again, right? So it's going down twice. If it goes up a second time, most bears will give up and they'll buy back their shorts, right? So they'll buy, and that is exactly where bulls are buying to go long, because you had 2 pushes down. If the market goes up, it's a high 2 buy setup. And so the bears are buying to get out of shorts. The bulls look at it as a high probability with trend setup and they're buying. So everybody's buying, and that makes it a very reliable buy signal. Okay? If you're trading counter trend, trying to pick a top, you might let the market go against you one time. So let's say your market's going up and you short below a bear bar. You might let it push up one more time. If it comes down your way again, you will not let it go up a second time. And that's why a high 2 is such a reliable buy signal. The bears are getting out and they won't look to short again for a while, and the bulls are getting in. So counter trend traders usually do not let the market go against them twice. They give up and they decide that the trend is trying to resume, and they just get out of their counter trend trade. For example, in a bull, a high 2 is the second attempt for the bull to resume, and if traders are short, they'll buy to exit. If traders are flat, they'll buy to get long. So you have the bears buying and the bulls buying, so the market probably is going higher. And that's why traders should get out of a high 2 if they're short, and why a high 2 is such a reliable buy signal. Everybody's buying. The bears are buying and the bulls are buying. Nope, there's nobody left to sell. You know, if everybody's buying, the market has to go up to find sellers, and that makes a high 2 a reliable buy signal in a bull trend. Okay, it's even stronger if the signal bar for the high 2 setup is a strong bull bar, a signal bar closing on its high. That makes it even a higher probability trade. Let's say you have a bear trend and you have a low 2 sell setup. It's a second attempt for the bear to resume. That makes it a higher probability trade. If traders were bottom picking, they'll get out. They will not let the bears try to resume the bear trend twice, right? There's too much probability that the bears will succeed. So the bulls who bought what they hoped would be a bottom are going to sell. The bears, if they're flat or if they're already short, they're going to sell to add to their shorts or to get short. So you get the bulls selling and the bears selling, and the market will probably go down, and that makes a low 2 short in a bear trend a very good trade. With both the bulls and bears selling, nobody's willing to buy at that price. The market has to go down to find a price where traders would be willing to buy. Okay? It's a stronger setup if the signal bar for the low 2 short is a bear reversal bar closing on its low, especially if it's at the moving average and the close of the bar is below the moving average. So here's an example. We have a gap down and a bear spike, and we're trending down. Bulls might look at this as a second entry long, a good looking bull bar closing on its high, and they're pretty confident they may not exit below this this bar. Bears might look at this and say, oh, that's not a great bar for the bears. I have a good looking long, I'm going to hold long with a stop below my signal bar. The market starts to resume up again, and now we have a low 2 sell setup, and this one is a bear bar closing on its low. These bulls who bought hoping to be picking the bottom, they'll let the market go against them one time here with the low 1. They're going to get out on the low 2. So most of the bulls who bought here will not wait for their stop to get hit down here. they'll simply get out below here. And the bears will short here for a scalp. It's a high probability trade. High probability tells you that the move probably will not go very far, right? High probability usually means small reward and therefore a scalp. And this went down far enough for a scalp. It turned out that this was a final flag and it led to the low of the day, but there was enough room for a scalp. A trailing stop, you have to keep adjusting your stop as the market goes your way because you want to keep your risk from getting too big. So let's talk about a strong bull trend. Every time the market goes up to a new high, if it goes above a prior high, you should be thinking about tightening your stop. So you raise your protective stop, you trail your stop, and you put it up to below the most recent higher low. Remember, if the bull trend is valid and it's continuing, it should continue to form higher highs and lows. So if the market goes below a prior low, it's probably now in a trading range and no longer in a bull trend. And if you're swinging based on the premise that it's a bull trend, you don't want to continue to hold that premise when now you're clearly wrong. So after every time the market makes a new high, the traders who are swinging longs usually raise their stop to just below the most recent higher low. Okay. If that recent higher low is too far below and the market is racing up, traders won't risk all the way to below its low. Instead, they'll look at the most recent very strong bull trend bar and place their stop below that, or they'll look for some other support level like a trend line and put a stop several ticks below that, or they'll simply use a money stop like 20 ticks below the most recent high in the trend. At some point, they'll move their stop to break even. If the trend goes very far in their direction, their stop will be much higher than break even, so even if their stop is hit, they'll end up exiting with a profit. Here's an example, a very strong bull trend. Let's say the traders bought above this bar, or if they bought anywhere in here for any reason. Once the market went above the old bull high, traders would raise their stop to below the most recent higher low here. So their initial stop was down here at the bottom of the bull spike or somewhere in here. Now that we have a new high, they'll raise their stop to below the most recent higher low. Once the market went up over here to a new high, they may tighten their stop to below this most recent higher low. Here, the market's transitioning into a trading range. It's no longer a bull trend, so traders will not use a stop this far down. They might, swing traders might for a very small position. A lot of traders probably would see this as a trading range. They could also see it as a higher high major trend reversal, and most traders would go flat because the premise that it's a strong bull trend is no longer valid. It's either a trading range or it's a weak bull trend, a broad channel. So once the market evolves into a trading range, you trade it like a trading range. You buy low, you sell high, and you scalp. And you do not use trend stops. You don't want to have very wide stops in a trading range. When I'm talking about buy low, sell high, and scalp, selling high, it can simply be selling out of longs. It does not have to be selling into shorts. For example, it could be exiting longs on any reasonable sell signal. So if you're in a trading range and you're long from lower down, and now you have a sell signal, you don't have to go short, but you should sell out of your longs. Very few traders like to reverse, and very few traders do it successfully. So if you're long and the market gives a sell signal, most traders will use the sell signal to sell out of their longs and not reverse to short. Also, if the market is still always in long, if you have a sell signal, it's only a scalp. So there's not much profit compared to the risk. And it's not necessarily all that compelling to take that short. In general, if the trend is still always in long, it's better off only to look for buy signals and not take the sell signals unless the sell signals are especially strong. Why not reverse to short? One of the reasons is most traders find it hard to be objective. So they're holding along for a lot of bars and it's going up and they're making a lot of money. It's hard for them to argue the bull case and at the same time objectively evaluate the bear case. You know, it's hard to do two things at once. It's hard to exit along and to go short. Most traders prefer to get out of the long and then look to go short, you know, 2, 3, or 4 bars later. It's very easy to make mistakes on your orders if you're trying to reverse as well. So for example, if you're long anywhere from down in here in a strong bull trend and you see this, it's probably good to go to exit your long because it's a possible major trend reversal, higher high major trend reversal, now a double top bear flag. So it's a possible lower high major trend reversal, all right? So I definitely would get out of longs. Most traders would find it difficult to reverse to short. Again, once the market evolves into a trading range, don't use swing stops. So you don't want your stop way down here or even down here. Now that the market's a trading range, you have to trade it like a trading range, and you use trading range stops. You want to be exiting in the top half of the trading range. You don't want to be exiting, you know, way down low. Okay, what about when the market's in a bull channel, a strong bull channel, very tight bull channel? Let's say you bought here. You bought the close of a strong bull bar after a breakout of a high 2. You could use a tight stop, 1 tick below your entry bar, or you could use a wider stop below the most recent higher low. Okay, if you're using a wider stop, you have to be trading smaller. If you're using a tighter stop, you can be trading a bigger size position because you want to keep the total dollars at risk the same. You don't want to exceed your comfort zone. The wider the stop, the higher probability of success, but the more ticks you lose if the stop is hit. Let's say you bought up here at the top of this bull bar thinking that this is an extremely strong bull trend day and you are confident it's going to go higher. And that is a reasonable assumption, and it is reasonable to buy up here. You might want to put a tight protective stop right below the low of the very big bull bar, or you might think, it could be a buy climax, we could have a bigger pullback. I'm going to risk to below the most recent higher low and put your stop down here. Risk is greater. It's a valid decision, but if you're using a bigger risk, you have to trade smaller to keep the total dollars at risk the same. Another example, the trend is resuming. We have an outside up bar. Let's say you bought somewhere here above the high of this bull bar. Okay, as soon as the entry bar closes, you could use a very tight stop, 1 tick below its low, or a wider stop below the low of the outside up bar, a smaller, most recent higher low. Again, the wider the stop, the higher the probability of success. Okay, here's that same bull trend day, and look what happened over here in the green box. Is it still a strong bull trend? No, it's the bull channel has now evolved into a trading range, so you should be trading it like a trading range. You should buy low, sell high, and scalp, and no longer use wide swing stops because it's no longer a bull trend. Break-even stop. If you, let's say you buy in a bull trend, a lot of traders will see the market go up a little bit and they'll allow it to come back to their entry price one time and they'll continue to rely on their initial stop. But once the trend resumes again, they'll move their stop to break even. They will not let the market go their way twice and come back to their entry price a second time. And that is a correct trade. A lot of times the market will come back a second time to the entry price but not quite get there. It'll miss it by 1 tick and then it will resume your way again. That is a sign of a strong bull. Okay? The bears tried to hit that stop and they came to within a tick, but the bulls overwhelmed the bears at that moment, and that's a sign of strength. And if the market starts to turn up again, they'll buy above the high of that test bar. That test is a breakout test. It's a test of your original breakout, and traders will buy on a stop one tick above the high of that bar. That's a reliable second signal in your trend. Here we have a bear trend, a pretty good trend line break, and a potential lower low major trend reversal. A bull inside bar at the new low. Traders will buy above its high, looking for a swing up. Not a high probability trade. Most major trend reversals have 40 to 50% chance of success, but because the reward is so big compared to the risk, it's a good trade to take. So let's say you bought with this blue arrow one tick above the high of this signal bar, and the market goes up a little bit and it comes down, and it would have hit your protective stop exactly to the tick, right? Okay, it's a breakout test. Most traders would stay long. A lot of traders would say, it's reversing up from the entry price with a decent bull bar, I'll buy more. Okay, or if they took a scalper's profit here, so now they have a smaller position, they'll put their full position back again as the market reverses above this bull reversal bar. Okay, the market's starting to go up again. Look what happened here. Okay, the market resumed up. Okay, and it came down again, but this time it missed the break-even stop. This red line is the entry price, right? So the market came down to their entry price once here, right? It hit their entry price. They stay long. The market started to resume again. A lot of traders will put their stop now at break-even, and look what happened here. The market came down to within their break-even price repeatedly and never hit their price. That's a sign of strength. So if the market starts to go up again, traders will go long. They'll place a buy stop one tick above the high of the most recent bar, and they'll go long here. So if they scalped out part here or here, they'll put back their full position over here on the perfect breakout test. It missed the break-even stop by a tick. You want a reward at least as big as your risk at all times. Once you determine your stop size, then you can decide on your risk. Market's in a trading range. Very strong bear reversal bar at the moving average. Probably will work. Therefore, probably means probability at least 60%. So therefore, you can go for a reward equal to your risk. You place a sell stop one tick below the bar. You get filled right here at this red line on this bar. You know your stop is one tick above your signal bar. You need to exit with a risk of at least as many ticks as, with a reward of at least as many ticks as you're willing to risk. So here's your initial stop. Here's your entry price. A measured move down is here. You also could have adjusted your risk based on actual risk, right? After this strong bear bar, traders would look back and say, oh, my actual risk is one tick above the high of this bear bar, and therefore go for a reward equal to the risk, and they would have been filled somewhere over here. Okay, we have a higher low major trend reversal. You can either buy above the bear bar or above the bull bar. Let's say you bought above the bear bar. Your initial protective stop is here. Your minimum target is a measured move up. So if you're looking at this as a scalp in a trading range, you'll probably be successful. If you're looking at it as a swing, you want to go for a reward equal to twice your risk, which would be somewhere up here, and you would have been filled on this bar. Okay, I mentioned in an earlier module that sometimes the probability is 90%, and you actually believe that it's 90%, and you are correct. Let's say you're in a strong bull trend and you have a limit order to take profits, and the market touches your limit order and then pauses or pulls back a tick or two, okay, and your limit order is not filled, okay? You're looking for a reward of one more tick but your stop might be 6 or 7 or 8 ticks below where the market currently is. At that instant, you believe that your limit order will get filled before your stop is hit. So you believe that the market will go 1 tick higher, 1 tick above your limit order, so that your limit order will get filled, and you're willing to risk to your protective stop, which might be 6, 7, or 8 ticks away. And if you're trading rationally, you can only do that if you are 90% certain. And that actually is correct. You probably are rational to have that belief. That is a correct belief. Every time the market is approaching your profit-taking limit order, and it touches your order but does not fill it, at that instant, if you're staying long, trying to get that extra tick, you're relying on your stop, which could be 6, 7, 8 ticks away. You could only continue to hold long if you're 90% certain. And that means that many times during the day, you are 90% certain of what the market will do next. But you're 90% certain it'll go 1 tick while risking 6 or 7 or 8 ticks. So to have that kind of probability, because of the trader's equation, it can never get too skewed one way or the other. To have that kind of a probability, you have to have a risk much greater than your reward, which in fact you have. This is the end of the module on protective stops.